Well, hello folks. Welcome to the webinar for Preparing for Investment. I'm James Proctor. I've got Naomi Johnson here from Social Investment Scotland. I'm from Community Share Scotland. We're going to do a couple of presentations on this. It should take around half an hour or so. Kind of run through these, and at the end we'll give our contact details. So if you do have any questions, or if you just want to run right to the very end of this, then feel free to do so. So Naomi's going to go through some of the stuff around more social investment, preparing for investment, talk about some of the things that Social Investment Scotland do as well, and then she'll hand over to me, and I'll finish off on community shares. So over to Naomi.
Great, thank you, James. Okay, so just to say what we're doing here today. So apologies. As James has just outlined, I'm going to be going through the what and wherefores of social investment before handing over to James, who's going to talk through the community share model. So to start us off, what is social investment? I always start this slide by saying there's only two words in social investment, and I think sometimes we tend to overcomplicate. Social investment in the Scottish scene invariably means loan finance. It refers to the expectation of a financial as well as a social return. Social return, investment, financial return. Social investment enables the creation or development of income generating opportunities. What do we mean by this? It's suitable for organisations that have an enterprise side, that are looking and seeking to make a surplus or a profit, whichever word you're most comfortable with. And the reason you have to make the surplus or profit is because obviously the money that is given through social investment is repayable. For this reason, it's not a substitute for funding. And we're really clear that just because you may have lost a chunk of what you might have as part of a funding package doesn't mean you can automatically plug in with social investment. You have to have that earned income opportunity there. Where it can be a real advantage is sometimes it enables organisations to finance things that a grant funder might struggle with. A social investment is made as a piece of investment that goes into your organisation, not into a particular project and particular outcomes. So consequently, it can enable you to upgrade IT systems. It can enable you to invest in the enterprise side of your organisation that might not have a direct social outcome. And so for those reasons, people use social investment to help their organisations grow and develop. This next slide gives you a sense really of where social investment fits. To give you a broad sense from this chart, and it's perhaps a little crude, but in essence, it reiterates the point that social investment fits at the point where you are earning money, not just asking for money. So it will fit organisations that are running contracts, maybe through service level agreements, right through to those organisations that are selling products on the open market. And increasingly we're seeing more initiatives where social enterprise organisations are selling products directly to consumers. Examples include cosmetic products, alcohol products, and even female sanitary products, a broad range, but they're all businesses that run to seek and make a profit. People use social investment for a number of different things. We tend to bring them together under these four key headings. Asset acquisition. Increasingly, we're seeing more communities take on assets that are transferred perhaps from the local authority. It could be community centres, it could be local leisure facilities, for example. And social investment can help an organisation in regard to that asset acquisition. We talk about social investment helping with easing cash flow. So this could be referring, if you have an enterprise activity in your organisation that you're seeking to grow and develop, it could be that it's in its early stages. Or as the contract develops, you need access to what is known as working capital to enable you to run a contract such that payments are then later made based on the results that you deliver. So social investment can help ease that cash flow. Equally, with funding losses, if you are setting up an enterprise activity within your organisation, sometimes you have to spend money to make money. So before the enterprise may start to turn over enough profit, you will have to spend and invest in that enterprise activity to enable it to be taken up by the market, to let people know about it. And that might mean that social investment can help in those early stages until you are turning a profit. And more latterly and slightly differently, organisations use social investment to bridge grants. So, for instance, where grant money is provided in arrears, such as European funding, in order that an organisation can take it on, sometimes they will take on loan investment to help them be able to spend and run projects until payments are made further down the line. So 4 key areas where you can use social investment. This next slide gives you some examples taken off the Social Investment Scotland website. I'll read through because it's a little bit blurry. There's lots of case studies on the website. So we've got examples here: Heroes Vodka, Lag and Wolf Tracks, which is a cycling initiative. New Start Highland is an employment and recycling enterprise. Sports Complex, you can see North Highland Radio, and you can see Our Power, which is energy related. So a real broad range of activities. And I'd encourage you, if you want to see more information about how different organisations have used social investment, to take a look at some of those case studies. Who is eligible? Social investment's available to a broad range of organisations, as shown on the slide. And perhaps the only additional point worth noting is to remember that social enterprise in itself is not a legal structure here. So social enterprise could refer to a company limited by guarantee or a community interest company, whether again a kick by guarantee or a kick by shares. So it's a real broad range in terms of eligibility. What we always say is ask the team if you're not sure. If you do want to find out more about legal structures for social enterprise, then First Port run a number of introductory courses on this throughout Scotland, and they are always worth finding out about too. SIS isn't the only provider of social investment, and I think it's useful, and indeed I think it's important that if you're looking at social investment, you actually look at a number of different providers that are out there. I think it gives you a good sense of who might be right for you. And this next slide gives you a real sense that social investment can be provided right through from high street banks, such as your RBS, your Barclays, your Lloyds, the social banks that we see through banks like Charity Bank, Triodos, Unity Trust. And then we've got organisations much like SIS, the non-bank social finance providers, Big Issue Invest, Social Investment Scotland, DSL, all different examples of non-bank social finance providers here in Scotland. So who's right for you to approach? When people come into SIS, we always ask people if they've approached the high street bank first. We do this for a number of reasons. Generally speaking, if you can get finance from your high street bank, it may well be your cheapest option for loan finance. However, the high street banks tend to want to take security. They will tend to want to loan money to organisations with a very strong track record, a proven model, and generally speaking, the amounts of loan that they would provide are at much higher values. And some of that same is true for the social banks. Again, they will want to take security, and you will need a good, strong track record. So the non-bank social finance providers really came in as an answer to some of the issues for social enterprise organisations and social initiatives being able to raise loan finance. It was addressing that gap in the market. And the key difference is really here is that they will loan money to organisations at a much earlier stage of their development. They will loan money to organisations without taking security, and they will loan money at smaller amounts. And 10k is the smallest loan investment that SIS has done, for example. However, I think it's important to say that high street banks do still have a role in how they've supported the organisations, that while they get a direct no on one level, it could be that some of the money that is then lent on to them through Social Investment Scotland has initially come from the banks in the first place. So it really is all of these organisations working together to provide social investment. Another example of that sometimes is it may be that an organisation is looking for a larger sum of money, and say 80% can be provided by a high street bank or a social bank where they take security, but there's still a small gap, say 20%, where that finance still needs to be raised, and the social investor can step in at that point. So it kind of works in partnership as well. Perhaps the final note just to make about who provides social investment is, I think I've said that, for example, SIS doesn't take security. However, it may still ask if security is available. And this is because it can have an impact in terms of interest rates that are then determined, and how that all works for you in terms of the terms of the arrangement. So you may still be asked if security is available, and you will almost certainly always be asked if you've approached a high street bank first. The last comment I really just want to make on this slide is I always think it's important when looking for a partner in terms of who you get investment from to look at what's happening in that wider financial market. What will happen if circumstances change? How are interest rates likely to go? It's a long-term investment, and you have to look into the longer term in your decision making, not just financially, but I think also in terms of types of partner and potential flexibility that you may need moving forwards. It's always worth getting the comparisons from different providers. I indicated in the last slide that the money for the social investors comes from a range of sources, and we said that the high street banks are one of those sources. Money's also been raised for the social investment through schemes that Scottish Government have run. We've seen examples where trusts and grant bodies have been increasingly interested in the loan investment side, and Resilience Scotland, for example, had support from Big Lottery in establishing that loan fund. We're seeing more individuals look at loan finance through the social investment tax relief system, and we've got particular leaflets and information available on that if you want to know more. And we've got corporates also looking at how they might support the social enterprise community through the social investor. And again, the big scheme that we have or have had at SIS has come through Asda more recently. And although that's finished, we are, in terms of their ongoing support, that money's still available, it gets recirculated, and we're looking at other partners who might be interested. So what are the terms? I've said that the lowest amount that SIS have lent has started at the 10,000 mark, with our biggest loan to date around the 1.6 million. One of the key issues in terms of terms is that the interest rates are fixed. This is done deliberately to help organisations with their financial planning and just really know what their commitments are moving into the future. And I've said that we do short and long-term loans. For those organisations perhaps looking at a bridging loan, this might be short-term up to a maximum of around 2 years, whereas longer-term loans could be running more in that 10 to 15-year period. All of the terms and conditions are worked through with an investment manager, and other than the short-term loans, interest rates and things are all worked out with an individual investment manager for you. I've talked a little bit about the taking security. I've said that we will always look to take, or we will always ask about taking security, but don't need to take it. But I think the most important point to get here is that no personal liability is required in terms of taking on a loan investment. And I make that particular point because we know that one of the barriers to social enterprise organisations taking on loan investment is often that board members are concerned that it puts them in a personal position in terms of liability, and it doesn't. So I think that's a really important point to be clear about. The only exception to that being about understanding issues around negligence and company law, which would be fitting regardless of whether you're taking on loan finance as well. So I always encourage board members to be clear on their full legal obligations. In terms of debt and patient terms, what we're really saying by that is that the investment manager will work out with you at what point repayments are best to start in terms of fitting with your business plan and your cash flow projections moving forwards. Obviously, we won't wait forever, but we do try to do something that fits in terms of your needs. The last point, just around some of the terms, and I always think it's helpful to tell organisations this, is that there are no early repayment charges through organisations like SIS. So actually, if you struggle to raise a loan finance through maybe a mainstream bank in the early stages, but then taking on a loan through a social investor a few years down the line enables you to then refinance. Those are options that are all open to you, given there are no early repayment charges. When I'm talking about loan finance in the social enterprise sector, I always think it's worth just noting that we know that grant finance is still the most common form of loan finance. And these statistics on the screen at the moment come from the social enterprise census that was undertaken in 2016. So from this, we know that 14% of organisations have used loans, but that 72% had applied for grants in the previous year. So it's still a significant form of finance, is grant finance for organisations. What I always just encourage organisations to understand is what the advantages and disadvantages of those different forms of finance are, and what's right for your organisation and all particular aspects of your business plan. I always think grants, it's really important to say, people, grants can be brilliant at enabling you to really fulfil social objectives that simply aren't available to finance through loan finance and through enterprise. And given we're all social based organisations, you know, that I think that's why grant finance is still really key. So it's often about that mix, and grant finance can also sometimes act as security and confidence really for the loan investor as well. So it really is about how all of these forms of finance fit together. In terms of just understanding whether you're ready for investment, and you'll often hear terms of investment readiness, I think, within our sector. I think the most useful way for organisations to look at whether they're investment ready is actually to use the SIS diagnostic tool, regardless of whether you're approaching SIS or another finance organisation, or indeed just want to use it as a bit of a health check for your organisation anyway. It can be a really useful tool to go through. So the diagnostic tool is an online tool that takes you through a series of questions looking at various aspects of the management of your enterprise. You can find the tool under the support tab on the SIS website, and then just scroll down and you'll see the button that leads you into the tool. When you go through the questions on the tool, and they're all organised around these 6 key areas, it will ask you various questions in terms of how your organisation maybe currently manages social impact, whether it's verified by an external consultant or not, whether it's embedded within all of your staff and board, all those kind of questions. And at the end, you get a bit of a sense of a score and how well you're doing in each of these areas. Now, you can submit the results of your diagnostic exercise into SIS, and it starts a conversation with an investment with the investment team, or you can simply just close the tool and use it for your personal information. So just, you don't have to submit it, and I think that's worth saying too. Perhaps my last slide before I hand over to James is, it's really important. There's no application forms when you come to SIS. In that sense, it's very different to maybe a grant process. Looking for loan finance all starts with a conversation. If we don't think it's right for you, we tell you quite soon, and we tell you what might make you investment ready in the future, if we can help with any of that. And if we can't help, we always try to signpost you to someone who can. So I just close by saying there's no such thing as a stupid question. Pick up the phone, ask the team, and if there's anything else we can help with, we certainly will. So I hope that's given you a bit of an introduction into social investment. I'm going to hand over again now to James, who's going to take us through the community shares model. So over to you, James.
Okie doke. We've got a minute or two while we change over from one to the other. Okay, folks, this might show, this might not. We've not really used the software that much. So I'm going to run through community shares, kind of the process, how it works, what it's kind of useful for, and hopefully that'll give you an idea about where obviously social investment in terms of sort of potentially loan finance might fit in, and where community shares might also fit in. We've done work together with Social Investment Scotland and with other providers as well, but there's also been programs where community shares have been the sole funder of things as well. So a variety of different ways to kind of do that. So let's run through this and see if it kind of helps you to understand what community shares are about. So really, it's all about for us investing in what matters. The key is that there's something going on in that community that wants to be community owned and wants to be run by the community and would actually provide a service or good or a need in that particular community. And that's what community shares can be really valuable for. So in this, we're going to run through what exactly are community shares, why would you use them, a few examples, and then talk a little bit about what Community Shares Scotland does and the support that's available directly from ourselves, and effectively why you would come to us if you want to do this. Because a lot of this you can essentially do it yourself. And so there's a kind of, well, why would you use Community Shares Scotland and what can we help with that you maybe wouldn't be able to do yourself. So key to this is the little bit in bold there is that this is a sustainable community enterprise, and really that is the fundamental thing we look at. We deal with a lot of inquiries and some really interesting stuff, but ultimately if this is not likely to be an enterprise, then community shares is unlikely to be the type of financing that's going to work for that organisation. So it's a way to help to fund this sustainable community enterprise, something that's going to be ongoing. The shareholders will invest in local enterprises, as it says, providing a good or service that meets a local need. So there has to be something about it that needs to be a thought of what is missing from this community or what would change this community. And that's why we kind of say, what is it that matters to this community? What's not happening? And could that be run by the community and effectively financed by the community as well? So we've used this for all sorts of different things. We've done pubs, shops, harbours, community buildings. Renewable energy has been quite successful, but lots of other things have too. Really interested in things like local sports and media, lots of other opportunities as well that we kind of are just at the kind of cusp, really, I suppose, of the early stages of what community shares are being used for. So we could look at things like housing, could social care or healthcare services, could nurseries, could these things be funded by community shares? Well, probably on a case-by-case basis, we'd really be interested in exploring some of those ideas. So, totally open to a conversation. Doesn't have to fit into the kind of things that have been done before. If you've got something innovative, then, as Naomi said about social investment, we'd be happy to hear from you, happy for you to get in touch, and we're happy to kind of run through that, even though it may not ultimately be something that might work for community shares. Hopefully we'll help you on your way. Legal forms, as Naomi said around social investment, there's a kind of open legal form. Well, we're kind of the opposite. We're very strict on the legal forms because this sits in a little kind of legal niche around who can issue this type of community share capital. So effectively, it can only really be a cooperative or a community benefit society. And all the ones that we've done so far have been community benefit societies. The key difference between those two forms is that they're both democratic, they've both got member ownership, but the cooperative society would normally benefit the membership and only the membership, whereas a community benefit society, effectively, the benefit is to the wider community. Members may benefit because they're part of that community, but that's not the direct benefit is not going back just to them. So it's not an exclusionary kind of model. And for the vast majority of things that we've done, that's been the appropriate model. Shops and renewable energy has been the appropriate model using a community benefit society. But we'd always be interested to see where a cooperative might kind of come into this. So we always keep that option open. There's a little bit different in terminology. People might be familiar with kind of legal forms like companies limited by guarantee, registered with Companies House. Well, quite different for what we call BENCOMs or bona fide co-ops. They are governed by set of model rules, which is effectively just the mem and arch or the constitution of the organisation. They're registered with the Financial Conduct Authority, so quite different. And they are just a registration body. They're not effectively a regulator. There is some regulatory function they perform by making sure that people live up to the act of being a community benefit society, but that's the extent of their kind of regulatory powers, really, to either register or deregister an organisation. So FCA, the Financial Conduct Authority, are who we directly deal with for registration. And we have, over the last couple of years, worked quite hard and successfully with Oscar to demonstrate that a BENCOM can be charitable. Yes, it's got share capital. Yes, that might provide some small return to the investors, but it can still be charitable if it passes the standard charity test. So there's no greater burden on a BENCOM than there would be for any other function, any other legal form to be a charity. But obviously, it has to still pass the charity test, just like any other organisation who wants to get charitable status. So let's talk about community shares. The qualities of them, we've kind of touched on some of these things, but really just to bring this together, would be that it is member-based. So effectively, at the end of this process of issuing community shares, the people who invest are going to be the members. You can take on a broader membership too, but it's going to be completely membership-based, and it's going to be democratic as well. So it doesn't matter if somebody puts in £100, £50 or £10,000, one person, one vote. As Naomi suggested, in terms of sort of social investment, we're very similar. Social return really has to be the key thing. It has to be doing something that's for the good of the community. There may well be a financial return to that, but the social return has to really be the driving force. The financial return is simply the way that you finance the business, finance the enterprise. It's not the key thing. The shares are a bit unlike, you might have heard stocks and shares, getting traded on the open market. The kind of FTSE index gets talked about and various radio stations and in the news time. Well, that's all about speculation and hoping that the enterprise increases and the value of the shares goes up. Not the case with community shares. If you invest £100, it's always going to stay £100. Actually, the worst case scenario is if the enterprise fails, obviously there would be no repayment of the capital. But these shares are called non-transferable and withdrawable. So you cannot, once you've invested in that, you cannot then pass that or sell that on to somebody else. They are your shares, they're kept in your name. The only way effectively you would get your money back, and it usually is built into the business plan, is that the way to get your money back is you effectively sell them back to the enterprise. So if from the enterprise's point of view, there has to be an idea that this is going to make some kind of surplus, and that potentially it's going to pay that surplus back partly, and it might actually sort of buy back some of the share capital it originally needed. Lots of other ways to do that, and we can talk more kind of in depth, not really for this webinar, about how that kind of works. But the key thing is that it's not speculative, so it's long-term, it's patient. The idea is that people are putting this money in because they want to see this enterprise be a success. We talk about minimal regulation. That doesn't mean no regulation, so it's not an open season. We do a share offer document, a prospectus. It just doesn't have to go through the kind of levels that a company would need to go through if they were issuing share capital. So a lot more straightforward, a lot more kind of down to earth, but still has to be open and honest about the prospects for this organisation. If it's a high risk organisation, it's got to state that. It's got to be clear. Things that have been done before, that's fine. Again, you just make reference to that, and that's something obviously we provide a bit of help and support with too. Benefits, as I kind of suggested, long-term patient capital kind of goes in there and hopefully will stay in there for a long time. Further funding and leverage, well, there's other ways to bring money in, so it isn't just that once you've taken community shares out that's the only funding you get. As we talked about, you can do all sorts of things with other lenders. They recognise community shares as a valuable way to part fund the business, but you may need other funding to grow or to do other things. Grant funding organisations have also largely accepted that community shares is a great way to put money in, and some of them actually will kind of use community shares as being the community's part to maybe a kind of 50-50 funding package. So they see the share offer as being the community's part, and then that will maybe unlock other funding. So it has been very useful from that perspective too. And that community governance and operation, it's just thinking about the relationship between the enterprise, if it is community owned, the difference that makes. People aren't just putting a donation in. They aren't just kind of giving some money and voting for the best. They actually have got an active participation in this enterprise. And to be frank, if things weren't going very well, they've got the opportunity to stand for the board, to make appropriate representations and to have their say. So there's a really useful mechanism for kind of resolving problems within that kind of community governance as well. Let's go through some examples. It's always kind of nice. We talk a bit technical about these things, but let's talk about what actually has happened and some of these things. So Sunart Hydro, £750,000 from 264 investors. It's as it says, a 100 kilowatt. You guys can read. So 100 kilowatt hydro electric turbine. Strontian, a fairly remote community out in kind of Ardnamurchan Peninsula, but raised a great amount of money. The key to that was that this is an opportunity for them to, yes, the hydro is important and is useful in and of itself, but obviously the potential is through the way that the finances worked for this to create a local community benefit fund. And it's partly that fund that will then help to fund other things that are going on in that community, which neatly brings us to one of the things they did do with some of the money, which is that they put some money into this community school. Fascinating project in terms of the school. It was going to be relocated. They wanted it to stay in the community. There was problems with able to build it on the campus of the high school. So they've raised £155,000 from 71 investors. Project's worth about £1 million. It's nearly finished now, and it looks almost exactly like that mock-up, which is always pretty amazing. Used some of the money from the Hydro, the Community Benefit Fund, to kind of kickstart that programme. Obviously also used their experience of having done community share offer to do a second community share offer for a different thing in their community. So a really interesting example of where a community had gained understanding of what benefit community shares could bring, and we're able to then apply it to a second project. And who knows, there may be other things in that community that might be appropriate as well as they kind of try and grow and develop it. If the school in a few years' time, if Highland Council are able to build the school on the campus, then this has been specifically built so that the school could move to maybe a new building on that campus. And then, as you can kind of see from the kind of way it looks anyway, is that the building would then become housing and affordable housing for the community, and that's something that they have quite a need for as well. So a really interesting and innovative example. At the other end of the scale, almost, Glenwivis Distillery, the biggest community share issue in the UK, never mind in Scotland, wanted to be a community-owned distillery, raised £2.5 million in 3 months, although that's a kind of credit to the kind of drive, determination and marketing, and how they were able to really kind of capture people's imagination with their proposal. So £2.5 million that they've raised for that. They've since gone on to do a second, more open offer and are getting close to £750,000 for the second one. And it's all about the regeneration of Dingwall, putting the distillery into the town. I think it's on the North Coast 500, if people know about that. So kind of a way to kind of bring tourists, not just to drive on past, but to stop off, to come into the town to spend money, quite frankly. And obviously the business itself wants to be a huge success as a community-owned distillery. They're also, I think, being almost completely, the energy sources are, I think, all going to be renewable energy sources as well. So that's kind of another kind of thing to that whole program of why this is so good for the community. So, you know, not just the jobs of the distillery and obviously the visitor and heritage centre, hopefully kind of putting Dingwall, I suppose, on the map in terms of whisky as well, and encouraging tourists and others to come and visit the town and use the kind of wider services that are there. Bread for Good, really at the other end of the scale. So we talked about £2.5 to £3 million for Glenwivis. Then Bread for Good have raised, well, as it says, just over £36,000. They were really about a really driven project around using heritage varieties of wheat to kind of create really healthy and organic bread. All about how to get that into the local kind of food chain and really kind of change people's minds and understanding about how important bread is to them. So, you know, lots of things that we're going to be doing as well, training programs, educational programs around the production of it. So, you know, a much kind of broader, wider project other than just simply baking bread and trying to get that into local, local cafes and that. It was really a training program, education program as well. So not a huge amount of money to raise for that, but, you know, potentially a really big impact. And community shares was a kind of key to making people feel literally invested, I suppose, obviously financially and emotionally invested in this program, and really be people who go out and speak to others about it. So, you know, not just investors being passive and giving the money, but actually being people who could go out and talk about Bread for Good as well as a program. And Port Patrick Harbour, terrific example of really capturing a community's imagination. It's been quite a long process around the harbour, whether it could be community owned, it was privately owned. Quite a bit of a kind of backstory to that, but then when community shares kind of was hit upon as an idea, it really accelerated, and I guess went from something that seemed like a bit of an idea that no one quite knew how to execute into something that could actually happen, you know, so quickly. And they really warmed the community up. The community were really behind this. So raising £75,000, in fact, I think they exceeded that target. I think they got closer to 100,000 in the end of it. Over that 3-week period was all because people really already understood that story. And the harbour itself was it's the equivalent of the village green. It's the real kind of centre of that community. So really important to Port Patrick. People coming to visit, mooring at the place, obviously getting facilities. And it's allowed them now, with community ownership of that, to open up other opportunities. I think they've done a community asset transfer for, I think, local toilets and local toilet facilities. You know, another little thing that they can just then kind of own and run, and that helps to make the harbour a far better place, and quite frankly, drives enterprise in the community as well. So that's kind of some examples of where community shares has really been used very effectively. We, as a program, kind of classic support organisation, I suppose, we do everything like this, raising awareness, and we do events throughout Scotland. We do happily go and kind of speak to groups. We work through all sorts of different intermediary organisations, but we also go and speak directly to groups as well. We've done some events with Social Investment Scotland and with others, and we do some of our own too. As a programme, we're basically here as well to provide support and advice. So we have, our website has stuff, but we often talk about just give us a call, and we'd rather give you sort of 15, 20 minutes of our time and chat something through and give you an idea of what might be done. Sure, it's great to go and have a look at stuff, and we wouldn't say it's a bad idea, but don't feel you get too bogged down in that. Come and speak to us, have a chat through it, and we can see whether that might be applicable. And we've dealt with some groups that have taken 2 or 3 years to come back to us with a kind of more fully formed idea, so no problem with that. We deliver training and advice. We do tools and resources. We're funded until June 2020 by Big Lottery Fund and Scottish Government. So I suppose if you do have an idea, there's no guarantee that we'll be here forever. So if you do have an idea, get in touch with us. That'd be useful to kind of maybe get a bit of information just now. But hopefully some sort of programme will be sustained beyond that. And we're delivered by the Development Trust Association Scotland, so we are kind of partners with the Development Trust, but we deal with many organisations beyond Development Trust. We've dealt with a few, but we've also dealt with organisations that don't have any legal form, or ones that have to do a conversion as well from other forms, and we can work through the complications of that too. Support that's available, so specifically when you get down to doing the community share offer, lots of support available, and some very specific support available to help you through what can be a complicated process. But with us guiding you through and holding your hand through that way should be relatively straightforward. We'll have its ups and downs, no doubt. So as I say, early stage, phone, email, face-to-face, doing things like this, webinar. But specifically once you get down to doing the share offer, then once we get to that point of really kind of seeing it's viable, we'll apply consultancy. It can work on a few different things. So this will be somebody who's a specialist in this, who's gone through community share issues before, who understands how to kind of put the community shares part of your financing into the business planning, into your share offer document, help you create that. We'll talk you through things like community engagement and your governance as well. If you're not a community benefit society or a co-op, we'll talk you through how that kind of works. And if it needs some specific help and support to do that part of things, we can offer that too. And the consultancy has sometimes been used even for things like PR and marketing, if that's maybe a weakness within the group or it needs a particular focus on, we can even offer to do help out with some of that. More often than not, that consultancy is around the business planning, the governance, and the share offer document, making sure that all those kind of financially things and all those kind of official documents are appropriate and have got the right kind of wording in them, and make sure they kind of stay on the right side of the law. We also provide, as well as that really useful consultancy, we also provide this up to £5,000. It's called a micro grant, but it's a simple grant, usually for the cost of the launch event, really the PR, marketing and communication costs around the time of doing the share offer itself. It can be used for things like specialist tax or legal support as well if there are particular issues around it. We've not really touched on taxation, but there can be, for certain businesses and enterprises, there can be some taxation advantages too. So that £5,000 or up to £5,000 grant, really useful for that kind of, where the organisation might be a little bit cash poor, but really needs to make sure that this gets as wide a kind of understanding as possible, because it's such a critical time. We link to other organisations, other support organisations. So if any of, as I say, those funders have kind of understood how community shares fits into their kind of ideas of funding as well. Always happy to talk to other people. If there's other funding already in place for a project, we can kind of talk to people and just make sure that everyone has got a full understanding of that. And then obviously access to all these kind of Scottish focused resources and tools. We know that whilst the UK law around BENCOMs and community shares is UK wide, it's the same across the United Kingdom, and the FCA, the registration body across the United Kingdom too. Well, there are some things that are very particular to Scotland, things like land fund funding and these sort of things. So we do have that kind of additional understanding. So as it says, all free of charge, or at least free at the point of contact, obviously paid for through grant funding from Big Lottery and Scottish Government. So that's kind of a fairly quick, I hope, run through community shares. As Naomi's kind of suggested, really, I think the biggest thing for both of our organisations, and indeed for most other organisations who deal in this kind of social finance or community finance area, is that don't feel that you've got to know everything or indeed that much before you get in touch. Really, just get in touch, have a chat. Similar to Social Investment Scotland, we don't really use many kind of specific forms. We might have a little contact form to capture your details, and then we can work on some other things. But you probably have already either worked on some stuff, you'll have some kind of either draft business plan or an idea sketched out, or maybe you just want to kind of start kind of from scratch and talk to us at that early stage, we'd rather, and we're always happy to have that kind of chat. So you can see on the screen in front of you all of our contact details, website, email and phone number. Both organisations, generally speaking, Monday to Friday. We would all certainly work out with that if there's meetings that need to be attended and things, but always happy to chat, always happy to kind of talk things through. And really, I suppose the key thing that we'd always say is that don't feel overawed by this. We try not to talk a kind of financial language or over financialize it. We know that the projects are the key thing. That's what matters to you. How do we deliver that project? The financing around it is just a mechanism, a way to help deliver that, to make that work. We would always make sure that we kind of try not to overburden you with financial language, but let's talk, and we'll talk in human terms about how best we can help to finance your project. So I hope that's been of some use. I hope it's not been too long. I hope it's been interesting enough. I think from Naomi and myself, we'd like to kind of thank you for your time, and good luck with your project in the future.